lost our last lecture, but I was able to recover it. I recovered it this morning, and so I'll be able to post this lecture and last time's lecture here probably sometime tomorrow if you're looking for those. I don't know how much you guys are watching those or what, but I'll put those up. Somebody had asked me after class to post the marked up version of the slides, which you've got to ask me. You can't come to me after the class is over because I've already closed it at that point. So somebody do me a favor and throw a pencil at me or something at the end of class so that I remember to save the marked up version because you guys want that too, right? Okay, so you got to remind me though, because my instinct is to just close the PowerPoint file, once I'm done with the lecture, and then it's gone. Okay, and then I want to draw your attention to Canvas. Couple of things that are important there. If you go into the announcements, I said if you go into, okay, there it goes, okay, and you click on, what is this? Wrong class, okay, that would help. I got in 121. If you go on to Canvas and you take a look at the announcements, once again, I did post an announcement about the revision to the syllabus. Most importantly here, most importantly being that, as you recall last time, we agreed that we would push the exam back to Wednesday next week. So it is not on Monday, it is on Wednesday. Okay, so that gives us an extra day to go over the practice midterm. That is the other thing I'm going to show you on Canvas that is sitting there now. It was there last time, but I've added some more questions to it. So if you've downloaded it, you might want to look to see what I've added since then and be mindful of the additional questions I've put in. The midterm will consist of 15 multiple choice questions and one free response question. The free response question is pretty much going to be, I think if we reverse that, it's a better, right? Yeah, because those front lights are off. The free response question is going to be a multiple step income statement, of which I have given you an example question now in the practice midterm, and come hell or high water, I'm going to go through that with you on Monday. We might get to it today, probably not, but we will absolutely go through that together on Monday. But you should start to take a look at that so that if you have questions, etc., by Monday, you could be asking about anything, but particularly about that one, since that's going to constitute in and of itself 20 points on the midterm out of the 100. 80 points will come from multiple choice questions. Okay, you need to bring that Scantron that I held up last time. Okay, the skinny green one that's got 50 response options on the front, 50 response options on the back. Any question on that? What form I'm talking about for the Scantron? Okay, you need to bring that. You need to bring your pencils, obviously. You need to bring your calculators, unless you think you got some sort of genius mind like you've been doing, and you guys seem to resist the calculator. I highly recommend you not only bring your calculator, but you are familiar with its functionality. Don't get in here and then all of a sudden you don't know that you got to hit equals twice or some stupid thing that they might want you to do with these calculators sometimes. All right? Any question on any of that? Okay. If you know somebody that's habitually coming in late and missing this announcement, make sure they know that the exam is not going to be on Monday. It's going to be on everybody? Wednesday. Okay, good. And that gives us an extra study day, and I don't think it throws our... Oh, very important. And it's only going to be what? Chapters 1 through 4, not 5. 1 through 4, not 5. Okay, and I don't think that throws our timing off too bad. I mean, we're a little behind the 8 ball here, but I think we can catch up at some point here with a little bit of strategy. Okay? Any question, guys? All right, good. Now what I want to do is go back to the Chapter 4 slides to wrap those up today. And I'm going to go back to change in accounting principle. I know we covered these slides last time, but I think we went a little bit fast because we were starting to run out of time, and I think I even got myself confused on one of the problems that I'm going to show you. I'm going to revise my statement on that because we were just sort of squeezing towards the end, and I got a little rushed. Okay, so let's just go ahead and let's take a look at what happens here. Company changes its accounting principle. Are companies allowed to change their accounting principle from one period to the next? Sure. Okay, now FASB doesn't want them changing it just because they think they'll get a higher net income or something. They allow them to change their accounting principles if they believe that the new principle will provide better, more useful information for our users of the financial reports. So if they meet those criteria, it's fine to change your accounting principle from period to period. However, because we have as one of our secondary qualitative characteristics of our information as consistency, they want us to put bright lines of disclosure around this change so that everybody knows that there's been the change. And the big deal is we're going to have to calculate the cumulative effect of the change in accounting principle, and it's going to require us to restate the beginning retained earnings of the earliest period presented on those financial statements. Okay, so we will restate any periods that have been presented, and then we will make a cumulative effect adjustment to the beginning balance of retained earnings of the earliest year presented, assuming we have comparative statements. If we have non-comparative statements, then our cumulative effect adjustment to retained earnings is going to be to the only period presented in a non-comparative set of statements. So I went ahead and I gave you this example last time, and we talked about how this company started operations in 2014. And in 2014 and 2015, they used a method for accounting for long-term construction contracts called the completed contract method. Completed contract method says that you do not take any profit on a contract until you're done. Okay? Now, another method that's available under U.S. GAAP is called the percentage of completion method. Percentage of completion method says that you can take income as you progress on a project. So you're about halfway done, you can take half the profit. 40% done, take 40% of the profit. We're going to talk about the specifics of the contract accounting in Chapter 5. That's not the point of this exercise. What I'm trying to show you here is that under completed contract for 2014 and 2015, since they were not done with these contracts, or the one contract, they could have several, they could have one, but their contracts weren't done yet, so they took 0 for net income in both of those years, right? Because they weren't done with the contract. Okay? Now, in 2016, they decide to switch to percentage of completion. Now, what does that do? In preparing their 2016 statements, they'll use percentage of completion, right? They will then have to go back to 2014 and 2015 and calculate what their net income would have been had they used percentage of completion in those 2 previous years. The only 2 previous years this company has existed, right? Because they started in 2014. Okay? So when they do that, they look and they say, okay, we would have had net income of $200,000 in 2014 if we use percentage completion, and then in 2015 we would have had $150,000 of net income if we had used percentage of completion, right? So we have to restate the beginning balance of retained earnings of the earliest period presented, don't we? Okay. Now, if we were preparing non-comparative statements, the only period we would be showing would be what? 2016, right? It would just sit there by itself. So the only period presented, the earliest / only period presented is 2016, isn't it? So we would say, hey, here was our beginning balance of retained earnings, whatever it would have been at the beginning of 2016. Here's the cumulative effect of the change in accounting principle, and we add what? The effect for the only 2 years that we were in operation, 2014, 2015, 200,000 in 14, 150,000 in 2015. So the cumulative effect is what? 350,000. We prepare our 2016 statements using percentage of completion, and I'm just making this number up. So our net income, since we're using percentage completion in 2016, is 90,000. And so our ending balance, assuming no dividends here, in our retained earnings is 440. That's non-comparative statements. We just make a cumulative effect adjustment to the only period presented, right? But we had to go back to all periods from the beginning of the company, even if it was 50 years ago, and calculate what the effect was for this change on all those earlier years. That becomes an adjustment to the beginning retained earnings of the earliest period presented, in this case, what? The only period presented, 2016. Okay? Now, if you are preparing comparative statements, since we have to make a cumulative effect adjustment to the what? Earliest period presented for all the previous periods effect of using the new method, if we had used those new method in those earlier years, we start with 2015's beginning balance of our retained earnings. We make the cumulative effect adjustment to the beginning balance, which is what? Just the 200,000, because the only year prior to 2015 was what? Was 2014. So we go ahead and we make that cumulative effect adjustment, 200,000. Our net income in 2015 is going to be 150,000 because we would have used percentage of completion to restate our 2015 statements. Any previous period presented, any previous periods presented have to be restated using the new method. So now we would have had net income of 150 in 2015 because we used percentage of completion to restate our 2015 statements, right? And then we would have gone ahead and shown the ending balance. Of course, 2015's ending balance is 2016's beginning balance. And then what? There is no cumulative effect adjustment because you make a cumulative effect adjustment to what? To the earliest period presented, right? And then you would show this year's 2016's net income using percentage of completion, which we've said is 90,000. Again, assuming there's no dividends, the ending balance would have been. And notice, the ending balance ends up the same place, right? It's just a matter as to how it's presented. Question? Question? Okay, this is how FASB wants us to present our statements when we're having a change in accounting principle. Put bright lines of disclosure around that. Okay, good. All right, so if there's no questions, then let's go ahead, and I want to jump to this question. And this is the one that I misspoke on because we were sort of rushing towards the end. I mean, I gave you the right answer, but I said something at the end that I think was the opposite as to how it works. I got myself a little twisted there for a second as we were kind of running out of class here. So I want to go back over this question, all right? So we take a look, and we have during year 2, Orca Corp decided to change from FIFO method of inventory evaluation to the weighted average method. Change in accounting principle. Perfectly acceptable, but we're going to have to account for that as what? As a cumulative effect. Okay, so is it a component of income from continuing operations? Is it a component of income from continuing operations? No. Is it an adjustment to the beginning balance of retained earnings? That change would be handled as a cumulative effect, wouldn't it? Okay. All right, so that's the answer. B is the answer, and we said that last time. It's not on the income statement, guys. It's an adjustment to retained earnings, isn't it? These other things are what? Trying to put it on the income statement? Well, adjustment to ending balance retained earnings is nonsense. Okay? All right, so that's the answer. But I wanted to explain how you would actually calculate the cumulative effect, and that's when I got myself a little rushed and said the wrong thing. Okay? So let's just take a look. If we have changed from FIFO to LIFO, and if we were looking at the end of year one to calculate the cumulative effect, okay, what would have happened? We would have had a beginning balance of our inventory, whatever that was. We would have had our purchases, whatever those were. That would have given us goods available for sale, right? And if they're telling us that at January 1st, year two, our inventory balance would have been 6,000 more under the new method, weighted average, that means that last year's ending inventory would have been what? Would have been 6,000 more had we used the new method in year one, right? So what happens? We go ahead and I'm saying that the ending inventory in year one would have been $6,000 more, wouldn't it have? It would have been plus 6,000. So we take what? Goods available for sale minus ending inventory. We're having a bigger subtract from our goods available for sale, 6,000 more, which brings down our cost of goods sold by 6,000, doesn't it? Right? We have a bigger subtract, so our cost of goods sold is down 6,000. If our cost of goods sold is down 6,000, our net income is what? Up 6,000, isn't it? Okay, so this is where I made my mistake. I think I said that would be a reduction of the beginning balance of retained earnings. It should be what? An increase. So we would show on our statement of retained earnings, we would show the beginning balance, whatever that was, I still can't get anybody to figure out an app or something where I can change the pen by just dipping my pen in a palette of, I don't know why they have it for all their other software, but not this one. So my statement of retained earnings, I'd have what? Beginning balance, whatever that is. And then I would go ahead and do what? Add the cumulative effect adjustment, which is what, a plus 6,000? Cumulative effect adjustment is a plus 6,000. And that would give me what? A restated retained earnings? And whatever that would be, and then I would proceed with my net income for the period minus any dividends, giving you the ending balance, right? Is the way the statement of retained earnings would continue. Guys, we don't have a lot of time, and we've got a tough concept here, so you either got to let me know you're understanding or tell me you're not, because I can't keep saying right to empty faces. So what is it? That means we're understanding it or we're not understanding it. Look, I understand it already. I don't need to explain it to myself. So if you're not understanding it, you need to tell me that. Otherwise, I'm going to suggest we just adjourn, and I'll see you on Wednesday. So that's it? I'll see you on Wednesday? Okay. So do you understand this? No, you don't understand it. Okay, thank you. That's what I need to know. Okay, do you understand that my net income would have been 6,000 more? Okay, so all I'm doing here is I'm taking my statement of retained earnings, and this is my statement of retained earnings for year two. Assuming non-comparative statements, it's the only period presented, I'm assuming here, right? So my beginning balance in my retained earnings, whatever it would have been, because I'm not calculating net income here, I'm just calculating that my net income would have been 6,000 more. I didn't tell you what the whole net income was, but I know it would be 6,000 more because my gross profit's going to go up 6,000 because my cost of goods sold is going down 6,000, right? So my gross profit would have gone up 6,000. My net income is up 6,000. That means my retained earnings should have been $6,000 more, right? So I start with my beginning balance, whatever it was. I add the cumulative effect adjustment to the beginning balance of retained earnings. That gives me a restated retained earnings, which is $6,000 higher now, isn't it? So I've adjusted it for the what? The effect of this change in accounting principle, which if I had used weighted average, my ending inventory balance would have been 6,000 higher. because they're telling me in the question that the beginning balance was 6,000 higher. Beginning balance is the same thing as the ending balance of the previous year, right? So I make this cumulative effect adjustment of 6,000. I'm just showing you what the statement of retained earnings would look like. Okay? All right, now I think you understand me. Now, look, nothing happens in accounting without a journal entry. I can say, hey, add 6,000 is a presentation in my statement of retained earnings as a cumulative effect adjustment, but I have to make a journal entry, don't I, to get my retained earnings to have the right amount in it? So I would make this journal entry that you see at the bottom, which is to debit and, I made another mistake. I'm debiting inventory 6,000 and crediting my retained earnings for 6,000, but I make this adjustment what? Net of tax, don't I? Okay, so I would go ahead and I would still debit inventory 6,000. That's correct. But when I deal with my my retained earnings, I'm going to have to do what? I'm going to have to take that 6,000 and multiply it by what? 0.7. That's going to give me 4,200. Okay? And then I would go ahead and credit, and this is beyond the scope of what we're doing in here, deferred tax liability. Deferred tax liability for 1,800, and don't worry about that right now. Write this. I'm going to write it on the board. Sorry, but this is just, I can't squeeze all this in on this thing. Okay, so I'm going to go ahead and debit inventory 6,000. That brings the inventory balance up to 6,000 higher, doesn't it? Okay, because I got to bring it up. I'm going to credit retained earnings, and I'm going to credit the retained earnings, and it's a net of tax adjustment, so I'm going to credit that 4,200. I know I need an $1,800 credit here to make this journal entry balance, and that's going to be a credit to deferred tax liability, because eventually this difference is going to do what? Is going to reverse, and I'm going to be reporting a higher tax income on my income taxes as I sell off this inventory, and this inventory reduces my cost of goods sold, so I'll have a deferred tax liability in the future of $1,800. But don't worry about that. That's beyond the scope of what we're talking about now. I'm just showing you the journal entry for this adjustment. Bottom line, the cumulative effect adjustment in this example wouldn't be 6,000. It'd be how much? 4,200, because you have to take that net of tax. So I should have shown this as what? 4,200? Because you show it net of tax. Okay?
What if after the adjustment, after the previous 10 years adjustment, they have an increase in revenue? How would they pay taxes for the previous years? Would they have to pay taxes on that?
You know, it's kind of hard for me to answer exactly because I'm going to assume that they would have also used a weighted average for tax purposes. But eventually, when they sell that inventory, the increase in value is going to hit cost of goods sold. And when it hits cost of goods sold, that will do what? That will cause them to have a higher taxable income, and at that point they'd have the deferred tax liability, and they would. So it's just the difference between the income tax accounting and the financial accounting that creates this timing difference. It eventually reverses. But we'd be here all day if I started to try to teach you deferred taxes. Intermediate 2. Okay? Okay, right now, cumulative effect adjustment of 4,200. Okay, good. Now you come over, and that's all I wanted to do. Okay, we did these other ones. I want to get us into comprehensive income. Okay, now we talked last time or a couple classes ago about comprehensive income. Comprehensive income is basically taking our net income and adjusting it for items that typically would go straight to the stockholders' equity. And we gave an example in here where we talked about unrealized holding gains on gains and losses on available for sale securities. Okay, and as we went through that example, we said what? If you had a gain in available for sale security, you would debit the security, you would credit what? Other comprehensive income for that. And then when we prepared our income statement, we'd start with net income, and then we would do what? Adjust it for this unrealized gain on available for sale security, this other comprehensive income. Okay? So they tell us here that comprehensive income, and comprehensive income is what? Is net income plus other comprehensive income. Okay? It's our net income plus our other comprehensive income. Okay? And they tell us that comprehensive income, which is net income plus other comprehensive income, is all changes in equity during the period except those resulting by investments by owners and distribution to owners. So you can look at that as what? Comprehensive income does not include sales of stock or dividends. Maybe it should be nor dividends. Sales of stock nor dividends. Okay? So let's think about this. If I sell stock, what's the journal entry? Assuming I sell the stock at par. Say I sell $10,000 of stock at par. Journal entry. Debit cash for $10,000. Credit what? Common stock for $10,000. Did stockholders' equity change? Stockholders' equity change? Okay, if I credit commons, okay, there's two stockholder equity accounts, well, three, that we really are focusing on in this class. Well, now we're going to focus on a fourth, which is comprehensive, other comprehensive income. But we have what? We have our common stock, we have our additional paid-in capital, we have our retained earnings, and we have other accumulated other comprehensive income as part of our stockholders' equity, right? All right, so is common stock part of my stockholders' equity? So if my common stock increases, my stockholder equity increases, right? Okay, so there was a change in my stockholders' equity from an owner's source, owners contributing what? Cash to the company, right? In the issuance of common stock. So is this part of my comprehensive income? This is good. This is not part of my comprehensive income because what? It was a sale of stock, wasn't it? Okay. All right, good. Now it says what? Distribution to owners. Well, that's a fancy way of saying what? I go ahead and I debit dividend for, just making a number up, 5,000. I credit cash, right? Then I go ahead and I close out my dividend to retain earnings, don't I? By doing what? Debiting the retained earnings for 5,000 and crediting dividend for 5,000. Did my stockholders' equity decrease? Change. Did it decrease? Yes. Stockholders' equity decreased because my retained earnings decreased, and stockholders' equity is part of retained earnings, isn't it? Okay, so in that situation, then I had what? I had a change in my equity during the period by distribution to the owner dividend, right? Okay, any other changes that happen to my stockholders' equity for the period are automatically considered my comprehensive income. So is my net income part of my comprehensive income? Yes, it is, and you can see it's written up here. Okay, comprehensive income is net income, right? Okay, so my net income is part of my comprehensive income because what? It changes my retained earnings, and it's not from an owner source. It's not a sale of stock. It's not a dividend, right? It changes my retained earnings, so it is part of my comprehensive income, right? Okay, good. How about if I have a discontinued operation for the period? Let's say I have a loss on a discontinued operation. Is that part of my comprehensive income? Yes, it is because it's part of net income. Very good, right? Okay. So the begging, burning left question then is, well, what is comprehensive income? What is other comprehensive income? What constitutes OCI? We know it constitutes net income, and we know that's part of comprehensive income. What constitutes other comprehensive income? OCI? Okay? And I'm going to give you a list right now of the things that constitute other comprehensive income. Ready? This is the list that constitutes other comprehensive income. Are you ready? Okay. Pension adjustments. I've got to get a new pen. Pension adjustments. Unrealized gains and losses. Unrealized gains and losses. I'm going to have to do something. Gains and losses on, what's AFS? Available for sale securities. Okay, so if we have an available for sale security, there's been a what? Gain or loss. We mark that onto the balance sheet as debiting or crediting the security for the gain or loss, and the resulting debit or credit is going to be what? To my other comprehensive income as part of my OCI. Okay, then what? Foreign currency translation adjustments. Now, guys, I don't expect you to understand every single one of these, okay? In fact, we're going to focus on the unrealized holding gains and losses because that's a little easier to understand to see the mechanics. This is just a list of the nature of things that constitute other comprehensive income, or the specific items, I should say, not the nature. The specific items that constitute other comprehensive income. Pension adjustments, unrealized holding gains and losses, which we're going to study a little bit closer. Foreign currency translation adjustment. Foreign currency translation adjustment is when I have financial statements denominated in, say, pounds, and I meet certain criteria, and I want to consolidate that with my U.S. dollars, because I have a foreign subsidiary that, say, is sitting there in pounds, and I have to first turn the pounds into dollars before I can consolidate, don't I? That process, because of difference in exchange rates, etc., will typically create a translation gain or loss. And rather than make the company count that as part of net income, FASB tells them, hey, you can stick that down in what? Other comprehensive income and make it an adjustment to your net income. Okay, in the calculation of comprehensive income. So foreign currency translation adjustment. And then the last one is effective cash flow hedge. An effective cash flow hedge. Last one is effective cash flow hedge. Okay? And that's basically when a company buys an instrument to guard against changes in cash flow that are different from what they expect when they have derivatives and these sort of things. And so if there are changes there in effective cash flow hedge, FASB doesn't make them run that through net income. It's part of other comprehensive income. And we're going to talk about the mechanics focusing on unrealized gains and losses now, because all of these other items, pension adjustment, intermediate 2, foreign currency translation, effective cash flow hedges, are advanced accounting topics, and I'm not expecting you to wrap your head around those. I just want you to know that these 4 things constitute for U.S. GAAP the other comprehensive income. Now, I wrote them in that order for a reason, because if you look, you can remember those by remembering Puffy, P-U-F-E. Okay, so if you just want to remember Puffy, pension, unrealized holding gains and losses, foreign currency translation, effective cash flow hedge. Okay, so a lot of going on here, guys, and it gets a little bit complicated in how you say it or how you spit it out or how you remember it, but you wanted to be accountants, right? Okay, so it is what? We have our comprehensive income. Comprehensive income includes what? Net income and other comprehensive income. Good. You add those together, that's my comprehensive income. We know what net income is. Net income is what? Is going to be our operating items, our non-operating items, our tax, our what? Discontinued operations, net of tax, right? Okay, and then we're going to have these other comprehensive income items, which all I'm going to expect you to understand at this point are these puffy items: pension, unrealized holding gain and losses, foreign currency translation adjustment, and effective cash flow hedge. Okay? Effective cash flow hedge. Don't worry about it. What I said, it's not relevant. It's not important. I can't teach you advanced accounting in here, so don't worry about it. Yeah, don't worry about it. Don't worry about it. Just remember those items. I can't be here. I'll be here all day trying to explain effective cash flow hedge to you. Okay? Okay, good. Now you come over and how do we deal with our comprehensive income? Our other comprehensive income and calculation of our comprehensive income. We can either show it as a single continuous statement, one statement approach, in which we'll calculate our net income, and then we'll continue on with our other comprehensive income items and calculation of our comprehensive income, or we could just start with a new statement, two-statement approach. We leave our income statement alone, and we start with our net income, and then we show you what the adjustments are of OCI. Companies have either of these choices as available to them. It's whatever they want. Most companies like to leave their income statement alone. So they'll just show you the income statement. Like when we looked at Apple's, we looked and they just had their income statement, but they did have in there another statement, which is the statement of comprehensive income, in which they start with net income and add other comprehensive income items. Okay? So rather than sort of talking in the air on this, let's just go ahead and let's look at the two-statement approach. There's my income statement, right? Sales, cost of goods sold, net income, and then they just keep going. And they do what? They start calling out the other comprehensive income items, which there's the 4, puffy. They don't have to have all 4, and we're focusing in here on the what? Unrealized holding gain and loss for available for sale security. So they had what? They had a gain. They added that. They came to the 140. Okay. Now, they could use the two-statement approach, in which they'd leave the little income statement alone. Don't mess with it. Just calculate it the way we've been talking about, net income, and then they pull out another piece of paper and do what? Start with net income, which came from the income statement, and add the other comprehensive income item in the computation of comprehensive income. So when you go home, you talk to your family about this, and they'll say, boy, you're really learning something, because I don't know what you're talking about. Okay? Okay? Question? Okay. Balance sheet presentation. Remember, guys, the accumulated other comprehensive income is like the retained earnings of the other comprehensive income items, isn't it? We went through this last time. Don't start feeling sorry for yourself if you don't understand something. I'm going to explain it in a minute. You don't click off your brain and start saying, I don't understand this, and get frustrated. That's not how you become a professional. Okay, you hang in there with it. Okay, so what happens? Accumulated other comprehensive income is the retained earnings of my other comprehensive income. Okay, we talked about that last time. We talked about this, and I walked you through the example. But let's just go ahead and let's look at this example right here. Okay, now I have a company that purchased an AFS security in year 1 for $500,000, and at the end of the year it had a fair market value of $600,000, and then we're going to go ahead and sell it in year 2 for $600,000. Okay? Now, when I buy the security, what journal entry should I make for the purchase of that security? I'm going to just write it in here. Good. Debit available for sale security, $500,000. Credit cash for $500,000. That's when I buy it, right? Okay. Now at this point, AFS security is showing what? $500,000 balance. Okay. Now by the time we get to the end of year 1, this security has a value of $600,000, doesn't it? Okay. So I'm going to go ahead and I'm going to debit AFS for $100,000, and I'm going to credit, good, other comprehensive income, and I would probably want to keep track of these by category. It could be the available for sale security, it could be the pension adjustment, it could be the effective cash flow hedge, and even if I don't report each one of those as a specific line item on my statement of comprehensive income, I'd have to disclose the components. So I could just show it as one amount, total those, show it as one amount, or I could show each line item. So I'm probably going to want to keep track of it by category. This is our U in Puffer. Okay, so I go ahead and I credit that for $100,000, right? Okay. Now, what you see down here are my closing entries. And in this example, guys, I assume we had revenue of $300,000, and I assume we had expenses of $110,000. I'm assuming we had revenue of $300,000. I'm assuming we had expenses of not $110,000, but $100,000. So my net income was $200,000, wasn't it? I'm not going to go through and show you all the entries during the year where we credited revenue and debited the expenses. I'm assuming you can imagine that. But now I'm closing them, right? So I debit my revenue to close that. I credit my expenses to close that. The difference, I'm ignoring income summary here, would go to retained earnings, wouldn't it? Because that's where my net income goes. Okay? And then what? I would go ahead and debit this, what, OCI gain on available for sale security. Okay? So when I had set this up, OCI AFS, this one right here, I credited it, didn't I? For $100,000. When I debit it, it closes, doesn't it? So OCI is like my net income, if you will, for the given year, isn't it? For this given year. Just like I close my revenue and my expenses back to zero because I keep track of them by year. So when I do that, then I do what? I credit to accumulated OCI. That's the retained earnings of my other comprehensive income. Isn't that what I just said? Okay. So when you pick up the statement of comprehensive income, right here, you have what? You have your net income of 2, your other comprehensive income of 100, and you have comprehensive income, which is the sum of the two of 300,000, right? Okay. When I prepare my statement of stockholders' equity, in my stockholders' equity statement, I'm going to show what? Retained earnings, assuming this was their first year of operation. Retained earnings of $200,000, and AOCI. What's AOCI? Accumulated other comprehensive income's 100,000, isn't it? Right? Balance sheet, income statement connection, guys. You got to work that muscle. That's the muscle that a lot of my students have trouble with. Understanding how you have the closing entries. The closing entries do what? Close net income into retained earnings, doesn't it? I also had to close my other comprehensive income account. I closed that to what? Accumulated other comprehensive income. That's it. That's all that's going on here. Yes, sir. Well, is my revenue zeroed out at the end of the year? Are my expenses zeroed out at the end of the year? Other comprehensive income is like a line item on my financial report that goes to zero at the end of the year because I keep track of my other comprehensive income by year, right? So that zeroes it out. Every year it gets zeroed out, and then I start again in year 2, just like I'll start again in year 2 with my revenues and my expenses, right? So this is like a net income number, isn't it? It's got to be zeroed out and gets closed out to the like retained earnings from my other comprehensive income. We call it accumulated other comprehensive income. With me so far? Okay, hang on. We're going to go into year 2 on this thing because remember we end up selling this security, don't we? In year 2? Okay, so let's do that first. In year 2, when we sell the security, right here, guys. This thing's driving me nuts. In year 2, when we sell the security, we debit cash for $600,000, don't we? We credit the security for $600,000. Easy enough, right? Okay. But what happens? We've got that gain sitting there in accumulated other comprehensive income right now, don't we? That $100,000? Well, it's got to get out of there because now this gain on a sale of a security is part of my net income, isn't it? Gain on a sale of a security is a non-operating item that's part of my calculation of net income. So I got to get it out of AOCI so that it can get into retained earnings now. So what I do is I go ahead and I debit my OCI other comprehensive income. I really shouldn't even call it gain. I debit other comprehensive income for $100,000. I really shouldn't call it gain. Other comprehensive income. What should I be calling it? AFS security. I debit that and I credit what? I credit, and I'm calling it normal gain. You wouldn't call it normal gain, but I want you to realize that it's not a what? It's not my other comprehensive income. It's an income statement gain, isn't it? Okay, and I credit that. So now I'll report that as a gain on the income statement, right? Okay. Now what happens? I'm going to go ahead and tee up over here OCI, other comprehensive income, what, available for sale for security? And it had started at 0, hadn't it? The beginning of the year? So now it's got a debit of $100,000 in it, doesn't it? With me so far? Okay, now in this example, which I'm going to write in, I purchase a second available for sale security. And I purchase it for $1 million. So what journal entry should I make for that? Debit AFS what? 2. This is the second one now, right? The first one's gone, isn't it? This one's gone. I had it, I sold it, right? It's gone, but I'm purchasing a second one for $1 million, crediting cash for $1 million. And then at, what's EOY? End of year, it has a fair market value of $1,400,000. Has it gone up in value? So I'm going to go ahead and debit AFS 2 for what? 400,000? And credit what? OCI for 400,000. That's for that second security, right? So when I go ahead and I credit AFS, OCI AFS for 400,000, the balance in here is how much? 300,000, and that's what I will report for my other comprehensive income for the period is 100,000, which consists of what? The 100,000 that came out and the 400,000 that came in, doesn't it? Okay. So when you take a look at my other my statement of comprehensive income, notice, guys, I've got revenue of 110 of 100. I've got what? I've got the OCI, the revenue of 100,000. I've got the let's just do this income statement just so I don't mess this up. I've got the revenue of what? 100,000. I've got expenses of how much? I mean, then I've got the gain here of what? Yeah, let me do the expenses. Expenses are what? Expenses are 90,000. So I've got what, like an operating income of 10,000. And then I've got a gain, don't I? And I've got that gain that's showing was 100,000, right? The normal gain of 100,000. I've got that. So I have a net income of what? I've got net income of 110. You can fight me all you want, thing. I'm going to fight you. I'm going to win this battle. Revenue of 100,000, expenses of 90, operating income is 10, gain of 100,000. So I got net income of 110. See where I got the 110 net income from? Okay, so there's my net income of 110. And I show other comprehensive income. My other comprehensive income was what? Was 300,000, wasn't it? So I show that 300,000. So my comprehensive income is what? 410 for the period, right? Okay. Now, when I show my ending balance in my accumulated other comprehensive income, notice that it's what? There's a credit there of 300,000. It started with what? It started with the 100,000 and what? Now I've credited for 300,000 to bring it up to what? Bring it up to 400,000. Right? It started with 100. I credited it for 3 more, didn't I? So it's now got what? It's not got 400,000, which it should have because I have that second available for sale for security, which I purchased for $1 million and now it's worth 400,000, right? Okay. So when I went through this process, guys, this was on the income statement. Don't get confused because I sat there and I did what? Because I sat there and debited normal gain. That's all on the statement of comprehensive income, isn't it? That all happened there, and the net was a 300,000 that got reported on the income statement that then got closed out to my accumulated other comprehensive income, right? The 300,000, so it's got a balance of 400,000. Now, when you look at that, users of the financial reports might look and say, okay, but how much of that was because you had an increase in securities you bought for the year, or how much of that was attributed to reclasses out of the other accumulated other comprehensive income into regular income, etc. So this disclosure would show that what? I had a beginning balance of 100. OCI before the reclass would have been 400,000, right? But since I had that reclass out of the 100,000, the amount that is reported on the statement of comprehensive income is 300,000. They could see that and then see that what? The ending balance is 400,000, and that's how we got there. So they're able to see amounts that came out versus amounts that came in for the period right here in this disclosure, aren't they? Okay? So it gets a little tricky in there when you start in the same period having gains and having amounts that are actually sold and become realized, at the same time having unrealized amounts that go in and out of the other comprehensive income, right? And so you've got to kind of sit there and follow that bouncing ball.
Well, why the expenses is 90,000?
I just made that up.
Okay.
I just made up the revenue and the expenses. I just made it up. That's how we got the 10,000, just to show how you would have, part of it be net income and then the rest of it, so you'd understand how I got the net income of 110. And then here comes the other comprehensive income for the period, which is the net of what? The AFS 2 gain of 400,000 and the AFS 1 sale, which took it out of other comprehensive income and put it into what? Put it into net income. That's where we got this 100,000. That's how that 100,000 is coming in. So I just made those numbers up for revenue and expenses. Question? Yes, sir.
If, let's say year 2, there was no other income and you didn't buy a second available for sale security,
Uh-huh.
the adjustment would basically look like beginning balance 100, adjustment minus 100,000. Now all of a sudden you have a net income of 100,000 with, I guess, an unrealized loss or adjustment loss to other comprehensive income, or comprehensive zero for that year.
Well, I would have, instead of, I would still have this right here, which is the gain, okay? But the only thing that would happen is this debit to OCI gain. So when I prepare my statement of comprehensive income, I'd start with the same net income here, 110 because I sold it. And then the other comprehensive income would be a loss. It would show as a negative 100,000, right? Because that was the only thing that happened. And then you'd have my comprehensive income, which would be 10,000, I guess, at that point, right? And then in the disclosure, I'd show beginning balance of 100. I'd have OCI before reclass would be 0, and then after the reclass would be a negative 100, and so we'd end up with the 0.
So mostly netted out, I mean, except for the 10,000, almost nets out to 0.
Yeah, it just shows that I had a secure. Yeah, it's a reclass. It's a reclass that takes it. I mean, think about it. The reclass did what? Took it. It was in the other comprehensive income part last year, right? Now it's out of that, but it has to escape somehow, and it escapes through the through the statement of comprehensive income, which we show it as a negative now, and then it pops up in net income, right? I guess is another way to think of it. Okay, but you got to do that reclass. Otherwise, it's forever trapped in accumulated other comprehensive income. If I don't show it as a negative on my other comprehensive income statement, it'll be an accumulated other comprehensive income forever, won't it? So I got to get it out of there. That's how I get it out of there. By debiting the OCI available for sale security, that gets it out of there. And then if you have new amounts that come in, of course, you debit or credit, because it could be losses, right? It doesn't have to be a gain. I'm just making them all gains here to keep us from losing our minds. One of these times we're going to get to the practice quiz. Make sense? Okay. Okay, good. So let's go ahead. And by the way, guys, I'm not giving you anything like that on these. If you're sitting there thinking, oh my God, he's going to kill us, I'm not giving you anything like that. I'm just trying to give you a feel for, let me back up a little bit. I'm just trying to give you a feel for the nature of things that constitute other comprehensive income, which is pension, unrealized holding gains and losses, foreign currency effective cash flow hedge. I want you to understand that we have two methods of presenting it, which is the one statement approach or the two statement approach. And I want you to understand all this is trying to do is give you a flavor as to the nature of things that are constituting those line items. I don't expect you to do all this. This is, I don't know what this is, okay? This is just me probably not having the sanity to stop, okay? All right, so let's go ahead and let's look at this. You're going to see it's a lot easier. According to FASB's conceptual framework, comprehensive income includes which of the following? Loss on discontinued operations? Yes, it does. Comprehensive income is net income plus other comprehensive income, right? Remember to say that when you walk in the door today, when you get home. Say, oh yeah, what were you studying today? Comprehensive income. Comprehensive income is other comprehensive income plus net income. Oh my goodness. You sound so smart. Okay, so that's a yes, isn't it? How about, I'm tipping you off on the answer. How about investments by owners? No. Investments by owners are not part of my comprehensive income, right? Okay, it's all changes except investment by owners and distributions to owners, which are dividends. Okay, good. Okay, let's look at this one. A company reports the following, blah, blah. What amount should they report as comprehensive income? Okay. How about sales? Gotta get that. How about cost of goods sold? Yep, good. So that gives me a gross profit of $200,000. Okay, good. How about operating expenses? Yep. Going to subtract that. That's 90,000. That's going to give me operating income, isn't it? Which we don't have to calculate for this problem, but let's just go for it. So that gives me what, 110,000? Okay, good. How about unrealized holding gain unavailable for sale security? Yes, it is. It's what? It's my OCI part, isn't it? What is it, 30,000? So must be 140 is my other comprehensive income. Is my comprehensive income includes net income plus other comprehensive income? Right? Okay. Okay, good. Let's try, oh, no. That's it? Oh, okay. All right, good. I got some other ones in the practice midterm. What do we got, 10 minutes? Let's start that thing. I want to take some questions. Oh, okay, yes, thank you. Thank you, sir. And then I'll go ahead and I'll post it up, okay? Okay, I want to get into this thing. Let's start it. Because some of these questions at the beginning are easy, and so I know you guys are tired, but let's just go ahead and start on it. That way we get rid of some of the easy ones up front, and then we're left with some that might be a little more challenging for us. But you should be able to now start to answer all of these questions that are in this practice midterm, okay? And as I said in the announcement, this is the best way to prepare for this thing. I shouldn't say that. This is how your test is going to be. It's going to be something like this. It's going to be questions like that from the different chapters, and then a full-blown question, which we will absolutely do next time, even if it kills us. We're doing it next time. Okay? All right, so let's just go ahead. But this weekend, you should be looking at this. You should be looking at all of your quizzes. You should be looking at your slides. So you should come in here Monday ready to rock as though that was the day of the test, so you can jam me up for questions. Ask me questions. Sorry, guys, I speak Hayward sometimes. Jam me up for questions means you're asking me, hey, what about this, what about that, right? Okay? Huh? Okay. You guys use that term, jam me up? No, okay. You got to visit Hayward. By the end of this class, you'll know how to speak Hayward, okay? All right. So what happens? You take a look at number 1. Accounting standard setting has been characterized as a... And you look at these others, pure deductive, pure, nothing's pure, using the scientific method. It's a messy political process. And remember I talked about how the preparers of financial statements go to Congress and put pressure on SEC and all that? Okay, so it's politics. Okay, everything is politics. Can you think of a situation that's not politics? Don't say love. Politics of love is one of the hardest politics there is to play. Okay. Can you think of a situation where there's no politics? Okay, there's no politics in this situation. A duck is on the water and an alligator comes out and eats it. There's no politics there. Okay, the duck doesn't go, hey, can we stop this and maybe I'll just give you a wing and you'll be okay. The alligator does its thing and the duck has no say in it, right? That's not politics, okay? Everything else in this world between human beings, there's politics. I don't care what it is, okay? Number 2, the FASB's conceptual framework. Well, there's also not politics in the score you get on your exam. No. You know, I say that, but look, if there's a question on the exam that you can make a convincing argument to me that, hey, John, you know, B had just as good a chance as C, and I picked B because blah, blah, I will give you the points on that. I would love for you to know this stuff well enough that you can convince me that, you know, there's a reason why one of the other choices had equal standing in your mind and have that be reasonable. And I'll give you the points for it. You know, this is like, you know, people with a hangover write these questions for the, you know, they could turn these into their graduate students and they have to be due by a certain date and the person does it the night before while they're, you know, drunk. Okay, so anyway, FASB's conceptual framework, qualitative characteristics of accounting information include, and we had what? We had faithful representation and what? Relevance. Good. Okay, so that's faithful representation. Okay, let's take a look at this one. The main issue in the debate over accounting for employee stock options was which employees should receive the options. Come on. The amount of compensation expense that the company should recognize. How many options should be granted to key executives? Come on. The tax consequences, you might think about that a little bit, but their main concern was what? The expense that was being reported. They didn't want the stockholders to see the expense associated with these options, and they fought hard to not have to treat them as expense. And you'll learn in Intermediate 2 that they now have to. When they grant stock options, they assign value to those options and they recognize the expense. Before that, they didn't have to. Okay? All right, good. I stuck this in here. I probably should have put it a little higher just to remind you that this is right off the slides for those annoying, you know, conceptual framework questions. This middle box right here is the one you really want to know. Qualitative characteristics are relevance, faithful representation. Ingredients are what? Predictive value, confirmatory value, and materiality. Faithful representation is completeness, neutrality, and freedom from error, okay? Oh, and know the enhancing clause. So I'm going to ask you from this little chunk right here, okay? I'll ask you from that chunk. That's the most common one that I see in different questions, okay? All right, good. So, number 4, fundamental qualitative characteristics include faithful representation and relevance. Good. Enhancing are what? You can just go up there. Comparability and what? Timeliness are the two that make any sense, that fall into, you know, that are, I don't list every one of them. Relevance, no. Relevance is a primary qualitative characteristic, not a what? Not an enhancing. Neutrality and consistency are getting into, well, consistency is what? Is an enhancing, and neutrality is an ingredient of faithful representation, isn't it? Okay. So the only one that really pulled items straight from that category down here was what? Comparability and timeliness. Okay, good. Letter number 6. And this is the last one we'll do, and then we're going to get out of here. Somerset Leasing received $12,000 for 12 months rent in advance. How should it record this transaction? Obviously, we're going to do what? Debit cash for 12, and since they got it in advance, it's a deferred revenue. Okay, so I'll ask you some stuff that really is an accounting 100 business 20 type of question, but since we did cover that in chapter 2, I'll ask you a few questions from there. Deferred revenue and unearned revenue are synonymous terms. That's right. Okay? All right, guys, let's stop there. We'll pick up at 7 on Monday. If you came in late, make sure you signed in. The test is not on Monday. It is now on, everybody? Wednesday. Good. You need to know chapters 1 through 4. Yes, sir. Yeah. I may, but if I don't, it's in the slides for chapter 1. It's one of the slides. Yeah. Okay, guys. Thanks. I'll see you on Monday. Make sure you sign in, please. So you need to let them know that we changed it, okay? The test date, because they'll be ready for it. Yeah. So you might have to try to reschedule another time with them. Are you going to take it at the regular time or a different time?
Tests, as far as I know, are always taken at the same time as the classes, just
Okay.
to avoid,
Yeah. If there's a problem, I'll be flexible if they say we don't have a time slot for you because it's so close to the date now. Cool.
Just remember, they said they want a 5 business day.
Right. So maybe we're close to the 5 business days. Yeah.
While you're here, and then we'll see.
Okay. Okay. All right. And if they won't give you the time of this class, we can schedule a different time that works for you.